Hi guys, how are y'all tonight? Sorry I'm running just a couple of minutes late. I was doing something for the registrar and looked up and went, oh! So, sleepy, I totally get that. I totally understand that. Okay, so the great thing is we are through the holidays. Woohoo! I know y'all are so excited about that. Most of you all of you actually should have got the email. I don't know if any of you've read it, that I sent out. And can y'all hear me all right? Okay, perfect. So I have been teaching accounting for nonstop 2 years. I took a little 2-month hiatus, but before that, 2 years solid. I have never, ever had 100% attendance. So congratulations. I'm really, really proud of y'all. That means that this is going to be an absolutely stellar class. And the grades are phenomenal. The average grade, the mode is a 90. The average grade is a high 80. So high D, it's like 85.97. So great job. There's a couple of confusion sometimes in dealing with assets and debits and liabilities and credits, and it gets very confusing where you can have a debit and a credit both under assets and a credit, because one's under assets and one's under liability. How can you have a credit and a credit? And it's because of the way that the account is actually affected. So, how many of you absolutely understand everything there is to know about accounting? All right, Chrissy, that's good. Okay. Candace, I promise it's going to get better. Okay, half and half. Okay, how many of you actually went to your book to see if you have the kind of cheat sheet that's in the very back? Perfect. So the ones that actually checked it and you see it, you're using it. It is, I call it a cheat sheet. It's there. It's just helping you have it in black and white in front of you to think through things. And that's the great thing. Let me get rid of that. Come on. Oh, love you. Thank you so much for doing that. Okay, so that screen's freaking out on me. Hold on just a second. I got my computer's, okay, got too many screens going. I'm going to move this over here. Okay, so use that spreadsheet. You will find that it will help you tremendously. And for the ones that's been using it, you're seeing the benefit, because you can actually try, if you don't know what cash is, you can go look at the little examples and find cash. So this shows us that cash is an asset and the normal balance is a debit. So the positive balance is a debit. So a debit is going to always increase the balance, where a credit is going to decrease it. On the opposite side, we can see that as a liability, which is accounts payable, the normal balance is always a credit, and that increases the balance. So a debit is going to decrease it. So that's where you're going to be able to see how things affect things. Yes, it's the very, very back. It should be the last 2 pages of your book. Perfect. Not a problem, Brittany. I'm glad that you're here. Okay, so before we get into Chapter 2 a little bit, let's go over Week 1. Woohoo! So let me kind of take attendance really quick. Like I said, I know that I can always go in on this, but I always just want to Brockway, Brittany Davis. There you are. Heather. Okay, I'm almost there. Candace, Christy, Stephanie was here, Tanisha, and hey Velma, I am excited that you're here. Okay, perfect. Okay, so assignment 1, 2, some of you had a little bit of an issue with. So I'm going to just kind of ask you the questions and wait for your response. Let me look at this really quick. And on some of these, assignment 1.3, there was a couple of them that everything was answered correctly, but you didn't put in the final total. So you did the little totals on each side, but down at the very bottom it asked for the final total and no one gave it. So that was one of the little issues. Actually, I'm going to do something differently because it makes my life easier. I'm just going to tell you, and so that's all that matters, right? It's probably going to tell me I'm kicked out. Okay, so before I start this, do any of you have any specific questions regarding last week's assignment? Are there any gray areas that you're not understanding so that we can make sure that we can pinpoint on that? Okay. Perfect, Brittany. Okay. Okay, everybody's doing good. Now, guys, remember you can resubmit. You have 2 attempts on your assignments. However, if you reattempt after the deadline, it does deduct 10%. But with that said, other than tests when you tests shut down on the deadline. So I have to go in and reopen them. You have 2 attempts on the test. You have 2 attempts on the assignments. It will always take the greater of the 2 scores. So if you don't feel good about an assignment in your grade and you want to reattempt it and it's after the deadline, same thing, you can still resubmit it and it's going to take the greater of the 2. So you're never going to lose anything because you attempted it a second time and then it counted against you. Okay, let me go to okay, 2.3 is the one that confused most people. So we're going to kind of walk through it. And let me see if it's going to let me do a new page. New page. Okay, perfect. Guys, I am horrible at, I don't want to highlight. I am horrible at Blackboard, but I'm getting there. I'm going to make this happen. So, we're going to determine if it's a indicate the impact of each of the transactions above on the fundamental accounting equation. This was assignment 2.3. Assets equals liabilities plus owner's equity. So we know that assets equals liability plus owner's equity. That's always going to be there. So, by placing a plus to indicate an increase or a negative to indicate an increase, the first transaction is provided as an example. So we're going to do assets, liabilities, and owner's equity. First transaction is owner invested $90,000 in the business. So how would we show that? Well, as an asset, we're going to debit, and I'm actually going to do a T account. Y'all are going to learn more about T accounts as we go through. Don't you love my handwriting? Okay, so we know that an asset, if you debit it, it increases the balance. So because we have $90,000, we're going to put a plus under debit. Well, the owner invested that $90,000, which means that we're going to credit or increase owner's equity. So we're going to put another plus. And because your debit and your credit are for the same amount, they zero each other out. So we are even. Now, as you get further in, you may have multiple transactions. So that $90,000 might have consisted of cash and equipment. So the owner's equity would still be $90,000, but your asset, your cash would increase and your equipment would increase, and those two transactions would equal the owner equity transaction. So they would zero each other out. You're equal. So don't be confused that you have to have only one transaction per one transaction. You just need to have $90,000 here and $90,000 over here so that together they offset each other. Does that make sense? Perfect. Okay, so the next transaction was we purchased $26,700 in supplies on an account. So on account means we actually charged it. But we purchased supplies, so again, we're going to get, our assets are going to increase, so we're going to debit them. And because we purchased this on credit, our liability is going to increase, so we're going to increase credit. Now, anytime that you are decreasing an account, you will use negative, and you need to note it because there's debits and credits on both sides, and they affect balances different. You have to notate which one, until you are 100% great at accounting and know how this is going to be, anytime you're truly debiting, or I shouldn't say that, I didn't say debit, decreasing an account balance, always use negative, or put the balance in parentheses so that they know to take away. Okay, so transaction 3 is we purchased equipment for $2,100 in cash. Okay, this is great. So we just increased our assets by $21,000 for equipment, and then this is where we get confusing because we paid cash. We're going to decrease or credit our cash by $21,000. So you wrote a check for it. You have to show that money's coming out of an account. That's where that negative's coming in. That's why we're decreasing our assets. When T accounts get more involved, it's not going to be this simple. You're going to have a T account for cash, one for accounts payable, one for equipment, one for owner's equity. Anything that you have is going to have a T account. So this is a very rudimentary T account, but it's getting you used to what you're doing. And then, of course, transaction 4 is we paid $6,000 for rent in advance. Well, because we're paying for rent in advance, and here's the difference. If you were just paying for rent, it would be an expense. However, because you're paying in advance, you're prepaying, and therefore that's an asset. So again, positive to prepaid, and we paid in cash, so we're depleting our checkbook. Is that making sense? Woohoo, I love all these yeses. Okay. Paid $2,100 for utilities. So that's going to be a negative. Oh, that's 6, sorry. And owner's equity is going to deplete as well, which is an expense account. So owner's equity is broken down by expense. This is one thing I kind of don't like, is this is saying owner's equity, where when you get further into expense accounts, you're going to understand. And I skipped 5, which is perform services for $7,800 in cash. Yay! That means that we get more money here. Perform services for $7,800. And then the owner's equity increased by $2,500. And I just messed up. Ignore that. That's there. Yeah, yay! Making money is good. Okay, so it seems like everybody's understanding this aspect of it, so that's great. So we're going to clear this page. Okay, don't want to delete anything that I wasn't supposed to. Okay, so then when we go to 1.3, again, phenomenal grades, guys. I'm so proud of y'all. Most of y'all did amazing on this as well, and it's taking what we just did and putting it in a spreadsheet form. And as you can see, as you could see, it broke it down to assets. So let's go do assets again. Let's do a smaller stroke. So we have assets, and that had cash. plus accounts receivable, very rudimentary, I know, plus supplies. Ooh, look, I'm getting fancy. I'm writing in cursive. Oh, it's fancy. Plus equipment. So, what's the difference between supplies and equipment? Okay, no response. So, the difference is supplies, paper clips, pens, cleaning supplies, copier paper. Equipment, the way I like to put it is supplies help you bill, equipment helps you earn. So the equipment could be a new lawnmower, it could be a new backhoe, it could be a new drafting board, or they have different uses. That's perfect, Amber. And that's exactly right. Equipment could be a new copier because it's equipment. It's large scale. Supplies are your little daily tasks. It does nothing to generate revenue. You can't very well charge your customer for a paperclip, but you can charge them for the use of a backhoe. I don't know why I do everything in lawn service and backhoes. I don't know why. I just do. If you're a massage student, it could be a new massage table, or what do massage therapists use? Yeah, it could be like a new massage table or a new massage oil. So oils would be supplies. Perfect. Because it's going to be used up very easily and very quickly, and equipment is going to be long term. So granted, with your equipment, it's going to be more smaller because, like I said, it's going to be maybe you bought a new table or you bought a new massage chair, maybe a new steamer for your rocks. Yes, hot rocks, thank you. I was trying to think of massages, I'm sorry. I just know I fall asleep. So that's a perfect example, is your oils would be your supplies, rocks would be supplies, but what they're actually laying or setting on is equipment. So that's the difference. And remember that you're also going to keep office equipment separate. So if you have a backhoe or a lawnmower and you buy that, but then you bought a new copier, office equipment and other equipment you're still going to keep separate. Okay, so we know that the owner invested $9,500 in cash to begin. And of course, this is not. So this is accounts payable plus owner's equity. Okay, so the owner invested $97,000 into cash to begin the business. That means that we're going to debit $97,000, and I'm cheating and putting a K. Don't ever do that. And he invested it, so okay, we increased cash and we need to increase owner's equity. And that's only because I don't have room for all these zeros. My phone's going. Okay. The next one is he paid $19,750 in cash for the purchase of equipment. So we know we decreased cash $19,750. Now you can use a negative sign or you can do the parentheses. Either one. Anything to show And this is important because when you add up your columns, you need to know what to take away. And if you do not denote that, you've just added up a lot of money. The difference would be 97. Okay, so our first column should total 87,690. If I don't know to denote what to take away, my balance is 189,710. I made lots of money. No, you didn't. So it's important that you know what to take away so that you have proper balances. And then equipment, we're going to increase. And because equipment is an asset, we're going to debit $19,750. Okay. So 3 was purchased additional equipment for $14,400 on credit. Great, man, I'm racking up equipment. I'm going to have a yard full of equipment. Problem is, now, because I just increased, I charged it, right? So now I also have to increase AP $14,400 because I have to show I owe this money. When y'all do my evaluation, please do not talk about how horrible I write on this whiteboard with a mouse. So this is the important part, is accounts payable. I just charged. I have to show that I owe $14,400. So this is just like when your Visa. You charge $1,000, your Visa balance goes up $1,000. Your AP, when you charge money, that balance goes up. When you pay money against it, that balance goes down. So plus $14,400 in accounts payable. We paid $11,800 in cash to creditors. Okay, great. Well, there went some money there. And make sure you're keeping all of this in their own little line. So again, negative $11,800. And we paid against creditors, so negative $11,800. Now 5 is the owner made an additional investment of $30,000. Well, this owner has some money, don't they? So 30, and because it was the owner invested it, 30. Now, what's the difference? Why do I not need, if we went to the bank and got $30,000, would I not increase owner's equity? Or do I not? Do I not? Okay. I did kind of phrase that weird. Because the owner invested $30,000, we put the $30,000 in cash, and we put $30,000 in owner's equity. But what if we went to the bank and got $30,000? Would I increase owner's equity then? Okay, so I've got a little bit all over the board. I've had some yes, some no, some decrease. Brittany, Bailey has it perfect. That would be a loan, so no. What we would do is we would increase the cash by $30,000, and where this is accounts payable, it's now going to be notes payable for $30,000, which is a liability. So the owner did not invest anything, so we're not going to credit his account. Perfect. Aha! I kind of like this. I'm stumping y'all. Getting you ready for this. Okay. wow, we made some money, so we performed services for $8,200 in cash. So of course our cash is going to increase $8,200 for this. And owner's equity, $8,200. In the real world, that would be service revenue. That would not be owner's equity. So I have to remember that this is general accounting because I'm sitting there going, no, because it's going to be broke down into more sub-accounts. But that's okay. I'm going to get used to it. And then we perform services of $6,300 on accounts. So how's that different? Well, we haven't earned any money, so we cannot increase cash. But we do now have someone that owes us. So we're going to increase accounts receivable by $3,000 because we have to show how much money is owed us. Perfect. Perfect, Heather. And then, of course, because we perform services, we're going to increase owner's equity. Because remember, revenue is earned as soon as the service is performed, regardless of how they pay. If they have not paid for it, but we did the work, we've still earned the revenue. And that can go on the books. If they have paid us, but we have not performed the services yet, that's a liability. We're going to put it on the books, but we're going to put it on the books as a debt, not as an earned income. Okay, and then 8, we paid $4,000 for rent, so minus $4,000. And owner's equity minus $4,000. Okay, so that's doing really good. And then we get down here to, we received $3,500 in cash from client credits. So that's where this client now has paid us. Yay, we got money. So let's increase our checking account by $3,500. And we have to show that their balance has went down. No different than when you pay on your credit card. You want them to show you that your balance has been reduced. So we're then going to debit, did I say it right? Sorry. Credit, accounts receivable $3,500. So that means that when you take $6,300 minus $3,500, we have $2,800 that is still owed to us for accounts receivable. So that gets the bulk of 1.3. Down at the very end on Analyze, it said, what is the ending balance of the cash after all transactions have been recorded? That's where most people missed, is they did not fill out that last little bitty bit. So other than that, everybody was looking great. Okay, does everybody feel good about that? You want to move on to what's coming up? Perfect, perfect. So I put your PowerPoint, I did the PowerPoint. Now let's see if I can get this. Now, I want PowerPoint to be to where people can see PowerPoint. Okay, so we uploaded the PowerPoint for Chapter 2. There we go. And we're going to get a little bit more in depth. We're going to start analyzing business transactions. And so in this section, we're going to record in equation form the financial effects of business transactions. We're going to define, identify, and understand the relationship between assets, liabilities, and owner's equity. Guys, if I have not said this before, it is imperative in accounting that you read your chapters. It is not like math where you read a chapter and go, what? I don't know why anybody assigned reading of math. I mean, all you can do is look over it and go, okay, I think I understand what to do. Accounting, you need to read it, and it will help you tremendously. Of course, there's the PowerPoints, there's different videos that Instructor Cook has done, and there's a couple of games and flashcards and stuff out there. Utilize your resources. You will find that it helps you tremendously in the end. Okay. Let me go where I want to go. Where I want to go. It's not going to be nice to me. I want. Bear with me. Aha! It's just being difficult on my side. And then I'm going between two screens here, so I apologize. Some of y'all have already done assignment 2.1, by the way, which is phenomenal. Okay, so this is where we're going to get into journal entries and recording those transactions, which is kind of taking what we already just did and putting it in a different form. So steps to analyze the effect of the business transaction is you're going to describe the financial event. So you're going to identify the property, identify who owns the property, and determine the amount of increase or decrease. And make sure your equation is in balance. So when you identify the property, was it their property? Is it my property? What is it? Is it equipment? Is it office supplies? Is it payroll? Whose is it? And how much does it affect it? So the property is kind of a loose term. It doesn't have to be property. We're not looking at land. So again, we went over this a little bit last time, but we're going to go over it again because you cannot hear this enough. What are assets? They're property owned by the business. But see, there it goes with property. There's more to assets than property. Assets can be, as you've seen, it can be physical property, land. It can be a car. It can be inventory. Anything that is to your benefit. So if you had to sell everything, what can you sell? And what would be left over? So if you had to close down your hair salon, you can sell off your perms and you can sell your chairs and you can sell everything. Now keep in mind, if you owe money on it, your asset's going to be the difference between what is owed and what you can sell it for. And you hope that it's to the positive. Liabilities are debts or obligations of a business. And owner's equity is the term used by the sole proprietorship. It is also the financial interest of an owner of a business, and it's called proprietorship or net worth. You're going to hear that term flipped back and forth a lot, and sometimes it just makes a difference between what term is being used on what type of business it is, but it all means the same. And then, of course, a balance sheet is a formal report of the financial position of a business on a certain day. It reports the assets, liabilities, and owner's equity of the business. We have these because, once again, you can't go into the bank and go, well, I do really good. I have lawns all over town. That's great. How much money do you have in the bank? How much of that is an asset? How much of that is a liability? If you have $100,000 in the bank, but you owe $300,000 in debt, and it's not property, you're not really doing that great. And a balance sheet's going to show you that. And that's what the bank's going to want to see. And that's what you as an owner wants to see. Where is my money? Is my money tied up in inventory? Am I cash heavy? Do I owe way too much money in accounts receivable? Knowing that you have money doesn't mean anything. You've got to know where your money is. Where are my assets? If I'm spending all this money in accounts payable, what do I have coming in? Where is it? If you have really high accounts payable and no inventory, something's going wrong. And then if you have a lot of inventory and not enough service revenue to justify it, something's going wrong. And that's where your balance statement's going to show you. And that is why it's so important that you understand how to read a balance statement. Because once again, if it's your bookkeeper, if it's your manager, your CPA, you might have someone else doing this for you, but if you do not understand how to read the bottom line, it's a moot point. And that's where so many businesses go wrong, is they're like, well, yeah, I had a CPA doing it, but you have to be able to know, okay, am I really in good standing? You can't just, the CPA can't just go, yeah, you're great. It's not his money. Maybe you're not where you want to be as a business, and that helps you make business decisions. Hold on just a moment. Okay. See, I'm multitasking. I'm emailing y'all. I'm doing everything. Woohoo! So, how is a balance sheet broke down? Well, it's going to, every financial statement has 3 headers. It's going to have the company name. Well, why is that important? It's my company. You might have more than one. I have my moments, but I also type really bad sometimes. Wells Consulting. Okay. It's my company. Why do I need it to say that? Maybe I have Wells Consulting and maybe I also have Wells Landscaping. And on top of that, maybe I have a landscaping company, and then I have a lawn maintenance company, and they're 2 different companies. So sometimes you might have multiple companies running out of the same business, depending on what's going on, and you have to keep that up. Plus, when you take this to the bank or you take this to the IRS, they want to be to identify whose this is. You don't want it to go in a file and they're like, this is great, someone's got great financials, I don't know who it belongs to. So you need that. You need to tell them what this report is. Is this the balance sheet? Is this the P&L? And what period is this for? Period is the last date for the end of the period. And you're going to have financial statements for monthly. Theoretically, you should do quarterly, and then you should do annually. So you need to identify that. You need to put November 30th, 2013. Then when you do the first quarter, from March 30th, 2013. And then when you do annual, you're going to write annual, December 31st, 2013. So you need to identify what everything is. That's always going to be your 3-line header. Assets are the amount of types of property owned by the business. So every asset account you have is listed with their balance. So we have cash, we have supplies, we have prepaid rent, and equipment. If there is an asset account, and the larger your company is, the more sub-accounts you're going to have. So maybe on top of this equipment, you had office supplies, or you had Cash supplies, prepaid rent. What do I want to say? Prepaid insurance. I mean, the more assets you have, the more you're going to list out. So we know our total assets are $103,500. Liabilities. Hey, they're doing great. All you have is an accounts payable. That's the only liability you have right now. If you had borrowed that $30,000 for the bank to invest, that's going to be a long term, so then you're going to list accounts payable, because those are short term, and notes payable, because those are long term. Bailey, don't worry about it. Go ahead and see you. Have a great night. Be blessed. So every liability account, again, is going to be laid out. And in owner's equity, there are only 2 transactions for owner's equity. Well, 1. Capital. And that's what's in there. And then when you add accounts payable and owner's equity, or liabilities and owner's equity, it totals $103,500, which is exactly the same amount of assets. So assets equals liability plus owner's equity. They're even. Any specific questions for this week? Because some of y'all are wrapping up. We've got 10 more minutes, but I want to make sure I address anything that I can. Okay. Now guys, this is going to be recorded, of course, and I will upload it tomorrow. So if you want to go back and watch this, just click on the YouTube. Right now, the links have been undone. Once you see that you can click on that YouTube hit, that means that you have the current video, and so you can watch it as many times as you want. The accounting equation and the financial statement. You're going to analyze the effects of the business transactions on a firm's assets, liabilities. No, Stephanie, I do not take cash, but I do take coffee and chocolate. Trust me. I'm fluffy for a reason. Oops, I lost my... So, accounting equations, financial. We're going to analyze the effects of business transactions on a firm's assets, liabilities, and owner's equity, and record these effects in accounting equation form. From that, we're going to prepare our income statement. So we have a balance sheet, an income statement, and then a statement of owner's equity. They all those financial statements follow the same order. Balance sheet, income statement, statement of owner's equity. No, I just said that backwards. I should have thought about it. Income statement, balance sheet, owner's equity. We also, larger companies do a cash flow statement. We will not be doing that. It's very in-depth and it's not worth it. We've went over before that assets equals liabilities plus owner's equity. You are going to have this in your head by the time it's done. The entire accounting process of analyzing, recording, reporting business transactions is based on this equation. Remember, night Heather, good night. Gia, I'm always afraid I'm going to say your name wrong. Oh, I thought I saw Heather. Sorry. Oh, okay, it was Gia. And remember that if we don't know one of them, we can always find it. It's just a simple algebra equation. So we're going to analyze the effects of business transactions on a firm's assets, liabilities, and owner's equity and record these in an equation form. We've already went over revenue is an inflow of money or assets that results from sales of goods or services, or from the use of money or property. It is also called income. Larger companies, you're going to have service income, your interest income, tax income. There's going to be different incomes. So right now it's really simple. You have income. The larger you get, the more types of income you could have. You could have dividend income. You have to report all that. And then expenses, an outflow of cash, use of other assets, or incurring of a liability. An income statement is a formal report of business operations covering a specific period of time. It's also called a profit and loss or a statement of income and expenses. So, like I said, you're going to have several names for the same thing. Again, we have the 3 header. The income statement has a 3-line heading. All statements will have a 3-line heading. And the 3rd line shows the period covering the operation. So month ending, quarter ending, annual. So on the income statement, we're going to, very first thing is list our revenue. And we're going to tell us what type of revenue. So this is fees income. Again, if there was a different type of revenue, if there was fees revenue, tax income, dividend income, any type of income you receive, you have to break out if they are from different types of revenue. So $47,000. Woohoo! That's great. That's awesome. Then we're going to list our expenses. Same thing. For every type of expense, you're going to have a different line. So expenses are the main category. Then you're going to go in and you have $8,000 of salary expense. Then you have a utilities expense of $650. So you're going to now subtract your expenses, just like you would in a normal situation, from your revenue. We had $47,000 of revenue. We only had $8,650 of expenses. So we had net income of $38,350. We made money. Woohoo! That's what you want to happen. If you had a negative, let's say we reverse that, if we had $47,000 in expenses and only $8,650 in revenue, we just lost $38,000. We are negative. We are in the hole. We are in the red. This is not a good thing. If we had $47,000 in income and $47,000 in expenses, and we broke even, our net income is 0, in a business, that's not a bad thing. That's actually good. It's actually kind of good in your personal life. It's always better to break even than go negative. And that's where you get, was the income, did we make money, did we lose money, did we break even? So if you're in the red, you lost money. If you are in the black, you made money. That's why an accountant will never, ever, ever write anything in red. If they write something in red, that means that it is bad. I will, to this day, not use a red pen. So we're then going to take that and we're going to, now this is important, we've got that $38,350. We're going to take that to figure out the statement of owner's equity. So we started out with $100,000 in owner's equity, December 1st of 2013. And we get that number because when we look back at the November 31st, she had $100,000. So December 1st, $100,000. We increase the income of $38,350 because we made money, less the withdrawals that the owner made. So the owner's like, you know what, I want to go on vacation, and it's my money, so I'm going to take $5,000 out. So we have to then take that $5,000 from our net income. So our capital increased only $33,350. So the owner's equity, December 31st, is $133,350. So that's why you have to do everything in order. Balance statement, income statement, owner's equity, balance statement. I do this all the time. I took 2 months off and I forget everything. So now we're going to go to the balance statement. And we're going to, bear with me just a little bit, guys. Same 3 headers, and we're going to just list our assets, cash, accounts receivable, supplies, same thing. Same stuff we just did. And it should total the $136,850. Liabilities, we're going to pull that straight over, $350, and the owner's equity. So if we did everything right, the balance statement's going to keep pulling numbers from one statement to the next. It builds. So you're not having to redo your numbers. You're taking the numbers from income statement, you're taking the numbers from the owner's equity statement, and you're putting it all on the balance sheet, and they should all match. That's it. Keep in mind a single line under a number shows that the amounts above are being added or subtracted, and the double line indicates that this is the final amount. Okay. That's pretty much it. There's a couple more examples of income statements. When you start doing your income statements, if it gets very confusing, and it can, reference your book and how they have it laid out and what they're putting where. It will help you. Remember, you've got my email. You can text me. You can call me. You can send me smoke signals, carrier pigeon. I'm here for you. So until next time, next Tuesday, same bat time, same bat channel, we will see you. Thanks for sticking by me exactly at 8. Y'all have a great night. Bye.